Hello, everybody. Welcome to today's edition of the 1 Million by 1 Million podcast. I'm speaking with Rami Elkhatib of Acero Capital today. Rami, welcome to the show.
Thank you so much.
So, Rami, let's start by introducing our audience to yourself as well as the fund. What is your focus? What kind of things do you like to do? What is the fund size? What size investments do you like to make?
Sure. So Acero Capital, we are exclusively focused on early stage enterprise software. The fund is $150 million is the size of the fund. Somewhat of a unique model, I think, in a couple of ways. We are a small team, so I am the only general partner, but I have a small, fantastic team that supports me. And, typically single GP funds tend to be either seed stage funds or micro VCs. So we kind of have this unique combination, like I said, of a small team, single GP, but more kind of a fuller size fund. And, so it's, and that's been kind of very helpful in pursuing our strategy. Our strategy is, so as I mentioned, to be an early stage investor in enterprise software. That's number one, and then number two, we're extremely focused on funding companies with deep IP. Our main focus when we're looking for investments is strong product, fantastic technology, and once we've seen opportunities that meet these criteria, really our goal is to make deep, concentrated bets, basically, in areas that we understand very well. Within that, our sort of most exciting investments and or where we get the most excited is when we see opportunities that actually require a lot of help and support and engagement from us as a firm. So these are typically the kinds of opportunities that we're looking for.
Rami, can you elaborate on how you define early stage, and especially when you're talking about deep tech? Are we looking at requirements that the entire product has been built and you have customer validation, or are we talking about companies already in revenue? Where is the sweet spot of the fund?
Yeah, and good question in the sense that this probably illustrates, like I said, I do think we have a little bit of a unique model in terms of how we think about, stage and check size. Maybe the best way to illustrate that is by way of an example. I can tell you about one of our investments that kind of illustrates that. So about 3.5 years ago, we made an investment in a company called Contrast Security that is really kind of, at this point, revolutionizing the application security space. That investment was a spin-out. There was a consulting firm basically that did consulting primarily with the NSA and a little bit with Wall Street banks, but their history was initially primarily with the NSA. And as consultants, they helped the NSA make sure that their software and software applications are secure. And as they were doing that work, they realized that there aren't really tools on the market, products on the market that help you properly secure software. Software security, if you're not using Contrast Security, is really still somewhat of a manual process. So they invented their own software, and Acero came in, and our Series A investment went in to spin out that software. So you look at that investment, that was our initial check was $8 million, which is pretty sizable. It was a Series A, obviously first capital, institutional or otherwise, first capital that the company took. So from our perspective, this met the criteria. The area of security and specifically application security is an area that we had been interested in. We found a fantastic technical team. We found the deep IP and the fantastic product. But we really ended up, when we closed that Series A, basically we had a full product and a full technical team, but that's all we had. The company was pre-customer, pre-revenue, even, kind of other than the engineering side, essentially pre-management team, and yet we invested $8 million in that company. So
Okay.
I don't know, hopefully that illustrates kind of where we tend to be a little bit different. I mean, I think, you know, a typical Series A, as probably your question alludes, is typically looking for that initial revenue, looking for the initial customers. And we've done that as well. But again, from our perspective, we try to take a different approach. Is there deep
Well,
IP?
I'm very happy to hear the example that you just provided, because among the various, you know, tools that we have pulled together in our, you know, 1Mby1M methodology is an extensive and very creative set of tools for bootstrapping, because, you know, if you have to make 1 million companies successful to some degree, you do need a lot of bootstrapping tools, because they're not going to all get funded. And one of the things we do in that process is bootstrapping using services. And you just described a scenario where the product was developed by a consulting firm, and they had visibility into a product opportunity, a problem domain, and they went and built the software, and then you came in, you know, to invest in a product that was already built, but with input from, you know, their consulting scenarios.
Absolutely. And this is, I think, a great way to go about it from the founders and entrepreneurs perspective. And again, from a venture investor perspective, it's also a great way to make an investment. But I do think, again, I mean, in a situation where, at least in this particular situation, the product itself was complete, but once we spun it out into its own company, I was basically addressing your question about stage and revenue and customers. You know, we were willing to write an $8 million check before there were any customers or revenue, because of all the factors that you mentioned. It's you know, it's a team that had known the space for a long time.
Right. Yeah. No, and that's very good, because we actually believe that bootstrapping using services is a tried and true method of building, especially fat startups, where you have to invest quite a bit or a lot of time and resources to come up with a product that is it's not a lean startup often, where several years of product development time has to go in before a product can be sold. And in those scenarios, bootstrapping using services is a very, very good model.
I completely agree. But it's also a model that requires patience. I mean, this particular, you know, team that I mentioned, probably their entire journey that led to kind of, you know, the spin out of the product. And again, you know, fortunately now they're doing very, very well. But their journey was about probably on the order of 10 or so years of
which
going
is often
through that
the
process.
case with these kinds of bootstrapping using services companies. They have bootstrapped for a long time, and then, you know, eventually arrived at a product idea. No, I'm with you. We've seen this case study, you know, this model of case study over and over and over again, and I think they actually make for very interesting companies.
I
in the long
totally
run.
agree, and also I think it's an example of, you know, when the time is right, sort of as an entrepreneur, you will know, right? I mean, I think, again, in my view, probably the best way to go through some of these journeys is that, you know, these are not folks that started out from day one saying, in fact, they're not even, you know, or they were not at the time based in Silicon Valley, right? They're sort of in the kind of DC, Maryland area. So they didn't start out saying, hey, we're going to start a company. They started out based on their very deep expertise building this product. But then when the time was right to connect with an investor and create a company, they obviously jumped on the opportunity. So that's another aspect of it is, you know,
Right.
I love it when it kind of happens organically and it just one day it kind of hits you that, of course, absolutely, we should start a company. You know, which is a little different from, you know, a lot of entrepreneurs maybe start from the other side first, right?
Yeah. And what about geography? You are based in the Bay Area, right?
Yeah. Our office is in Menlo Park. Our investments, at least in terms of when you look at the headquarter of the company. So, for example, the example I just gave you, Contrast, that started out as an East Coast investment, but as we built the team, that, you know, the new CEO that we recruited is here in the Bay Area, and then the CEO built kind of the management team around him in the Bay Area, so the headquarters is in the Bay Area. But you know, another way we look, I mean, I gave you Contrast by way of an example of how we are typically trying to find deep IP, but like I said, where we can come in and add a lot of value to the start of the company. Another aspect of that is geography, in the sense that, I mean, if I were to pick another example from our portfolio where we've done that, a company called Swerve in the mobile user engagement space. That company started its life as an Irish company. And when I met the team, it was basically, domiciled in Ireland. They had very, very deep and interesting real-time streaming analytics technology, but they were using it in a very narrow space. They were focused on user engagements within mobile games only. They were focused on pretty much, primarily the European market, and it was a company run by its Irish technical founders. So we came in, our investment in that company, again, it wasn't just, just the simple, I think in that case, it was a $6 million check that we wrote. But as part of our investment, we actually re-domiciled the company here in the U.S., not because we have to, we don't have a requirement that our companies have to be in the U.S., but for this particular company, it really made sense because for them, it was all about taking that awesome technology, but applying it in a much broader way. And much broader way meant not just the mobile gaming market. You go after the enterprise mobile apps, and then from a geography perspective, you base it in the Valley and you go after the market globally.
So you're comfortable with teams everywhere, anywhere in the world, but you eventually create some sort of a bridge with Silicon Valley so that your companies can tap into the ecosystem of Silicon Valley's management teams and infrastructure.
Absolutely. That's how it's worked out so far. I mean, again, it's not a hard and fast requirement. I mean, I can imagine a situation where I actually looked, we didn't make that investment, but we came close. We looked at a company in the UK once where it wasn't necessarily, going to sort of move its headquarters to the Valley, or that was something yet to be determined. So, we're open-minded about it. It just, to your point, if we're looking to add a lot of value and if we're working with an international company, typically part of the value that we can add is help them tap into the U.S. market and the Silicon Valley ecosystem.
Yeah, and we see, as you can imagine, because of our mission of this being a global virtual accelerator, we see an enormous number of international companies. And, our read basically is that it's great to be able to do a lot of the development and validation work in another place because of the cost structure of Silicon Valley. It's very difficult to bootstrap here. But once that is done, in terms of market entry and building the full go-to-market team and strategy and so forth, the U.S. is still the best place to set up that operation, and Silicon Valley is definitely one of the considerations, partly also because, most exits happen in the U.S., right? So if you have a structure where you are in some Timbuktu place, the probability of a company wanting to exit, wanting to acquire a company in Timbuktu is much lower.
Yeah, I fully agree with that. At least certainly in terms of kind of the propensity of at least the percentage of exits that happen in the U.S. or by U.S. companies. But when we do these types of kind of opportunities that start out globally, a lot of times we're really looking for the engineering team to remain where they started.
Exactly.
Right?
Exactly. Yeah. I fully agree with that. Yeah.
Right.
And there are very, very good engineering teams abroad right now.
Absolutely. I fully agree. And you can do sort of this interesting overlay then at that point with Silicon Valley technical resources, where you can also have technical leadership in the Valley, but it would be kind of more focused on, very specific challenges, but sort of the day-to-day development of the platform, remains basically where it started.
So what trends do you see? Let's say if you look back on the 2017 calendar year, what have you seen in your deal flow that you can synthesize as key trends?
Well, I guess I'll answer this in two parts. The first part is, again, because we are very focused on enterprise software, we really look at trends that essentially end up, persisting for 5 to 10 years and beyond. So since we began investing this fund a few years ago, really for us, the combination of mobile, cloud, and data, the intersection of, and data meaning, big data, the intersection of those three things basically colliding has essentially completely reconfigured the enterprise IT market and structure overall has been completely reconfigured. And that's something that, has lasted at this point, depending on when you want to start, counting, right? I mean, the iPhone came out in 2007, for example. So, this is something that has persisted, or the collision of these three trends has persisted for a long time and will continue to persist for a long time. So there is this kind of, side of the trends where there's a lot of continuity really in the enterprise market, but obviously one day something else will come along and kind of reshape the landscape. So we're always, trying to be on the lookout for that. And then within that, there are also the kind of more, I guess you can call them local trends, areas of interest that come and go. Some of them stick, some of them don't. So, for example, in 2017, at least from my own observation, we started to see a lot less focus on AR, or at least AR, VR, or at least the pure plays within AR and VR. But AI has started garnering a lot more focus, right?
AI is huge right now.
And for us, AR and VR never really became an important investment area for our fund, only because, just kind of the deep, widespread applications within enterprise, obviously they're there, but they didn't just kind of intersect with the areas in the enterprise that we're looking at. AI, on the other hand, is turning out to be a very different story.
Yeah. How do you process the current investment climate where capital is moving further and further upstream? How does a seed investor mitigate the Series A gap? There are like 500 to 700 micro VCs in the industry right now, and hundreds of, literally, 100,000 probably seed deals a year, but the number of venture deals is still in the 1,200 to 1,500 range. How do you process that trend?
To be honest with you, that is kind of one of the drivers of our investment strategy, right? Part of how we tackle that trend, we believe, is it basically creates the need for a venture firm that has the ability or desire to to make full Series A type investments. Again, it goes back to what I mentioned earlier on companies that have deep IP, even though the go-to-market yet hasn't been fully demonstrated. So from our perspective, we look at it as an opportunity where our model and our value add hopefully can be helpful, to some of these companies that have not really reached the typical kind of Series A setup, but we'd be willing to take a Series A bet on companies like that if we have a lot of conviction about the space and the IP.
So you are okay with not having everything figured out, and you're still willing to invest in companies based on hypothesis, with the assumption that with the right funding and the team infusion into the deal, you can scale?
Absolutely. Again, it has to start with our conviction that the team has built the right technology. I guess that's really the one area. We won't go in pre-product, right? We need the product, or at least the core of the product, to be something that can demonstrate to us that it really solves an important problem. Once we find that, exactly. In fact, not only are we willing to do it, it's actually our preference to be engaged in these kinds of investments because we get to add a lot of value early on, right? Whether it's re-domiciling the company.
Well, and it's a gap, right? Because a lot of the Series A investors right now are looking for real metrics, like they want to see $1 million, $2 million in annual recurring revenue, which is not easy to get to. So if you're willing to come in before that, when all those pieces are not fully figured out, fleshed out, you actually have a competitive edge, because there are lots of deals that haven't yet figured that out.
I agree. In a way, I think of it as a gap that probably at least partially sort of explains why we as a firm actually came about and why we put this fund together. So yeah, I agree.
How do you process unicorn mania? Are you chasing unicorns?
No, not really. I mean, again, typically we're either the first institutional investor so our entry point into a company is either the Series A or Series B. And in a Series B scenario, we'd come in and lead a Series B, again, only if there's a situation where, let's say, a company, again, has awesome technology, but it's pivoting or, changing its geography, like the Swerve example that I gave you. So by virtue of the timing of us entering those companies, I mean, we're coming in at early stage valuation. So for us, unicorn type valuations are something that don't really affect us in terms of, our entry into an investment. If any of our companies grow to a point where somebody wants to come and invest at a unicorn valuation, we'll welcome that opportunity, but it's not
What
really.
would you do? I mean, so if you have part of the problem that we see in the unicorn trend is that a lot of companies are getting artificially bloated up by later stage investors, and that creates huge problems for earlier investors with the preferences and all that.
I absolutely, completely agree with that. And obviously, I mean, I want to be respectful of a lot of, the unicorns that really, have the actual value that they got funded at. But I mean, to be completely real about it, to your point, a lot of those companies have inflated valuations. I think it creates problems from an investor perspective. That's number one, in terms of the earlier investors. And number two, it also creates problems sometimes when you overfund, you really kind of lose the discipline, right? I mean, you get companies that, I mean, now because you have the money, you kind of have to use it, right? And because you have to use it, I mean, I've seen a lot of examples where management teams start to spend on areas that they don't actually understand very well.
Right. And then the exit options become much more limited, right? If you have so much money that you have to put return on investment on, then, there are very few companies that will be able to acquire the company. So you have to go public or just.
Absolutely. No, absolutely. And then see, because we're typically the early investors in the company, we have a lot of control in terms of how the future rounds are structured. And one thing that we really focus on within our portfolio companies is capital efficiency, right? I mean, it feels good if people are chasing you with very big checks and high valuations, but we've actually turned down within our portfolio companies checks that ended up being much larger than the company needs, specifically for this issue of distraction. And
I think that's the right strategy for the time where we are in enterprise software. There are a lot of large companies out there that have, large companies. There are mid-sized companies that have reached critical mass. There are tons of SaaS companies in the 50, 100, 200, 500 million range, and they're all looking to acquire. So if you have capital efficient companies, you could find excellent exits into these companies. And if you bloat them up too much, those exit options go away.
Yes, I completely agree. According to the last set of data I saw, something like 80% of M&A exits, 80% happen at a valuation below $125 million. And your point is exactly right. I mean, the typical venture firm, frankly, loses money on or struggles to make an investment gain on that type of deal. But if you're an investor that funded a company in a very capital efficient way, maybe you came in early and there's an early exit and you're still the first investor. I mean, you can make
build a company for $5 to $10 million, sell it for $100 million. Everybody makes money, and it's a great outcome.
And that's a 10x. I fully agree with that. I mean, we've actually already had one exit, and this is our first fund that we're investing in. We've already had one exit, which basically followed that playbook to the T. And it was an extremely good outcome for us.
Very good. Well, wonderful conversation. Rami, if you would please stay on the line. I want to say goodbye to our audience, but then I want to chat with you a bit about something that I want to send you to look at.
Sure.
Audience, thank you for being with us today. as you know, we have weekly working sessions. Every week we have the free public roundtables where you can come, you can bring your project, and we'll work together to figure out what strategic issues that you need input on and guidance on. So go to the website 1Mby1M.com and sign up at the free public roundtable page. If you're in the Bay Area, you can come meet me in person at one of the 1 million by 1 million rendezvous at Cafe Boroni in Menlo Park. We meet pretty regularly, almost every week there. So that's also another place where we could work on your business and strategize. In any case, keep listening, and we'll be back with another edition of the 1Mby1M podcast. Thank you for coming.